as I was thinking about this topic today of taxes and tax returns, it made me think about how that is not a part of the business plan. And I think it should be. This business plan I'm going to call From Infancy to Legacy. It gives you the starting and the ending. And that's what we're going to be going through all this year so that you can put your business together. You can put your business plan together like a book. It's going to read beautifully, something that you're going to revisit every year on an annual basis to make sure that you're staying in line with the things that you put in it, that you're updating it and revising it as necessary. You're going to always go over and repeat your mission, your vision, and your values. And that's going to be under your summary and goals. So I'm going to put 7A is administration. Something that I didn't learn in school was about administration of a business. And when you think of my MBA, that's a master's in business administration, but it doesn't really tell you what to do in administration. It gives you some overall broad things that administration covers, but not really tell you what to do. So I'm going to give you 5 different tax returns that may be helpful to know about. But before I get started, here's a word from our sponsor. This video is sponsored by Fellow Accounting Solutions, where we offer premium bookkeeping, payroll, and tax preparation services at affordable rates. Let's see how we can service you. Send us an email with your contact information to get a free consultation. So the 5 different tax returns that I'm going to be talking about today is the most popular. 1, the 1040. That's for individual returns. Everybody knows about that. Who has ever filed a tax return? You have 1040 short form and long form, easy, 1040A. Depending on your scenario, if you don't have a business and it's just you or you and a spouse, it's going to be 1040. That's your personal return. Number 2, your partnership return. That's a 1065. When that return is done, it's going to distribute the profits or losses of the partnership through a K1. Each partner is going to get their share, and that's going to be put with their 1040 to complete and file their tax return. Number 3, the S-Corp. S-Corp, like an LLC, is a pass-through type of entity. That tax return is the 1120S. And basically it acts as a pass-through, but it has to have its own return. An LLC is filed on a Schedule C, but a S-Corp is filed on a 1120. A Schedule C is part of your 1040. A S-Corp has its own tax return and is also given a K1 for the shareholders. And the profits or losses is distributed on a K1 and given to the shareholders. Just remember that if you have an S-Corp, it's going to be filing its own tax return that is separate from you as an individual. The 4th type of tax return is a 990. Those are for nonprofits. Unless you're an exempt nonprofit, like a religious organization, a church, then you have to file a 990. And there's also something called a 990 easy and a postcard. That's if your 990 didn't bring in a certain amount of revenue, you can get away with the postcard or the easy. The 990 is a return that the IRS, you're required to file by the IRS, and it is, or it can be made public because it usually has or comes with a 501c3 designation or one of the exempt statuses as far as not paying taxes. That means that it's open for inspection upon request for the most part, especially the 501c3s. And definitely if you're receiving federal, state, or local funding, because those are taxpayer dollars and taxpayers got the right to know where their money is going. That's how that works. So the nonprofit tax return is the 990. The last tax return, the most common, is the 1120. That's for C corporations. The only thing that's different, well, there are many things that's different, but I'm going to highlight one of the things that's different between the S-Corp and the C-Corp is that the C-Corp, it's a lot more complex. The books are more complex and the taxes are more complex. You can have retained earnings inside of a C-Corp. Whereas with a Schedule C and S-Corp, those are pass-through entities, which means that all of the money for the period that you're accounting for, it has to pass through the entity, and you have to either claim a profit or a loss from it and pay taxes. Whereas in a C-Corp, the corporation itself can hold on to money. Just like in a nonprofit, the organization can hold on to money. It's called a fund balance. So those are the 5 types of tax returns. And know which one fits your organization. One of them will. If this lesson has been beneficial to you, don't forget to hit that like button, tap that subscribe button, hit that notification bell. And as always, I look forward to seeing you in the good life.